CNBC TV18, embarking on a quarter century of excellence.
Welcome back. As promised, let's now invite Gautam Baid from Complete Circle Stellar Wealth PMS to discuss market fundamentals and his approach to the market in 2024. Gautam, great to have you on the show, and season's greetings to you. I think it's been a pretty rewarding year for most investors, no matter what side of the market you were invested in. The question is that, how should we look at things in 2024, given this run-up already? Are you as optimistic as we step into the new year?
Well, first of all, thank you, Surabhi and Reema, for having me on the show. And I wish all the viewers of CNBC TV18 a very happy new year in advance. Yes, 2023 has been a great year in terms of portfolio returns for many investors, especially because most of us have our portfolios in small cap and mid cap stocks. And this year, many of these companies have got heavily re-rated. So the earnings prospects look very good going into next year, but valuations have become quite a bit of a concern in many pockets, especially in the hot themes and sectors like PSU companies, railways, defense, EPC companies, power, renewable energy. So just need to keep valuations in mind as we go along into the new year.
Gautam, let's talk about then some stock ideas, right, for 2024. Fusion Microfinance has been a favorite of yours for a while now. At what price did you enter in?
In our PMS, we entered into the stock at around 400 levels, and the stock has done pretty well for us. In our PMS, we like to invest in companies which are experiencing tailwinds. And when you get regulatory support, like the microfinance industry got from the RBI in March of last year, that greatly helps boost your earnings profile. So last year in March, the Reserve Bank of India removed the 10% net interest margin cap for microfinance companies. So now these microfinance companies can price their risk appropriately. Additionally, the RBI allowed microfinance companies to have 25% of their aggregate loan book in non-microfinance activities like gold loans, personal loans, etc. So the addressable market for the microfinance players has greatly expanded. Fusion Microfinance is one of the leading microfinance players in the industry with assets under management of more than 10,000 crores. And in a commoditized industry like lending, cost of funding becomes a big competitive advantage. And Fusion has greatly benefited from the 2 rating upgrades from CRISIL in the last 11 months, because of which its cost of funds have come down and its net interest margins have expanded significantly. In the latest quarter, they reported net interest margins of more than 13%. The company enjoys return on equity of more than 20% and return on asset of more than 5%. But when evaluating a highly cyclical industry like microfinance, we should look at cross-cycle normalized ROAs and ROEs, because in this industry of microfinance, it is very vulnerable to black swan events like demonetization, COVID, heavy flooding in certain geographies. So, geographical risks and all these black swan events should be kept in mind. And it's also very, very prone to socio-political risks. So that is why, just keep these particular risks in mind when investing in this particular industry. In case of Fusion, there is one more risk which I would like to highlight, that because it is majority owned by private equity players, you will constantly keep getting supply from these private equity players every now and then. And that may act as short-term overhang on the stock price from time to time. Just recently, the PE players sold 10% stake in a block deal.
Yeah, I remember Warburg just sold, I think, 2 weeks back, a near 9-10% stake in Fusion Microfinance. Any concern when you chat with the management about asset quality? Is there a risk that that might deteriorate, say, in 2024?
Well, in the recent conference call, this question was asked by many analysts, and the management exuded confidence that the asset quality concerns will be taken care of. They are facing some stress in states like Punjab and Haryana. As in the case of Haryana, for example, the unemployment rate is northward of 35%. So, because microfinance industries caters to the lower strata of society, there obviously the risks have to be kept in mind due to economic conditions in each specific state. But the total AUM from the loan book in these 2 states was less than 5%. So I think on an aggregate portfolio level, the asset quality should be fine.
Okay, so that's your stance on Fusion Micro and the microfinance space. Let's talk about the other stock that you like, and that is APL Apollo. It's delivered decent returns this year, around I think 50% this year. What's the thesis and the thought process over here?
So, Surabhi, I'll share both the thesis and the antithesis for this company. The basic thesis for this company is that in our PMS, we like to invest in companies with supply side dominance, that is dominant market share in their respective industries. So APL Apollo Tubes, with a 55% market share in the structural tubes industry, enjoys that supply side dominance that we look for. The company has got a great track record of execution and scaling up capacities in a timely manner. And when a company increases the share overall proportion of value-added products in its product mix, you get increasing margins with increasing revenues, and that makes an expensive stock look less expensive in the future. So the management has guided for the share of value-added products to go up to 70% by FY25 from 55% currently. And they've also guided for increasing trajectory in their EBITDA per ton. The EBITDA per ton stood at 4,500 rupees in FY23. For FY24, FY25 and FY26, the management has guided for EBITDA per ton of 5,000, 5,500 and 6,000 rupees. That's going to be primarily driven by the new Raipur plant, which is primarily going to focus on value-added products. In that particular plant, they're targeting EBITDA per ton of 6,500 to 7,000 rupees. So I think over time, with increasing margins, the current valuations will keep coming down, and the earnings growth will keep the stock price trajectory pretty strong.
Who would its direct competitors be, and how would their ratios compare with APL Apollo, Gautam?
Well, there are a few listed players in this space. I believe JTL is one of the competitors of APL Apollo in the structural tube segment, and you also have Hariom Pipes, which operates in a similar industry. This industry is basically very fragmented, so there are a large number of players. But in the organized industry, where APL Apollo operates, that is where we are actually focusing on, because that is where it enjoys dominant market share. And what the benefit of investing in these sector leaders is that with each passing crisis, the sector leader keeps on gaining market share and keeps on becoming stronger. However, I would like to also share the antithesis here for APL Apollo. Because of the industry it operates in, it's vulnerable to an economic slowdown, which may take place in the future. And also the promoter Sanjay Gupta also has economic interests in various other listed companies. So it's very important that his bandwidth is not stretched too thin, and that he does not expand his interest in additional businesses in the future. So these are the antithesis pointers to keep in mind for APL Apollo.
Okay, I was just checking. APL Apollo Tubes 10-year stock CAGR is 60%. Can you believe it? It's quite phenomenal. 60% CAGR over 10 years. Gautam, thank you very much. You wanted to say something?
No, I'm just saying it's commendable. I mean, that's a very consistent performer over a decade.
Absolutely. Get into a break. Gautam, thank you for joining in. We'll come back, discuss market technicals. Vitesh Thakkar joins in next.
CNBC-TV18, embarking on a quarter century of excellence.
Thank you for watching CNBC-TV18. For all our top stories and news updates, follow us on our social media platforms.